Hello there, ProfitPilot here. Today I want to take a look at 4 stocks that could profit massively from a return to normality, or in other words, have massive upside as the economy starts to reopen. So the first stock on this list is Starbucks. Their stock price is actually higher than at any pre-pandemic point. And looking at the 6-month chart, we can see the stock price is nearly up 22%. However, this does not necessarily mean that it is too late to invest, as Starbucks continues to show promising signs of growth to current and prospective investors. Prior to the pandemic, Starbucks was increasing revenues by roughly $1 to $2 billion on an annual basis. In 2020, they did take a massive hit with losses of more than $3.3 billion in revenue and nearly $3 billion in net profits, as stores were limited to drive-through and curbside pickups. But this may in fact have been a blessing in disguise, as it forced the company to adapt to the change and emphasize mobile ordering and delivery. With the mobile orders seeing an 8-point increase and usage of the Starbucks app and the associated loyalty program being up 15% year over year. Looking at the various app stores, we can see not only the overall positive rating, but also the sheer amount of people who downloaded the app. Combined with the optimistic outlook the company has, with it planning to expand the amount of stores it operates by at least 60% over the next decade, from 33,000 to 55,000 locations. Of these 20,000 new stores planned, 600 are meant to already open over the next 12 months in mainland China, the company's fastest growing market. 1 in 10 of these will be so-called Starbucks Now stores, a to-go format with an emphasis on speedy digital payments intended to accommodate pickups for delivery riders, which in my opinion shows how the company is trying to adapt and expand its business model a little. And for those of you who don't know, the company does pay out a small dividend that is however growing relatively fast, with an average growth of 20% over the last 5 years. As well as being uninterrupted for the last 10 years, and which Simply Safe Dividends rates as being safe, meaning it will probably not be suspended in the near future. Moving on to the second stock, we have Louis Vuitton Moet Hennessy, ticker symbol LVMH. So if the name wasn't a dead giveaway already, LVMH operates as a luxury products company in a wide range of industries. From fashion, watches, perfume, to alcoholic beverages, and yes, even luxury tourism services such as hotels and amusement parks, and many more. Some of you might joke about how this seems closer to an ETF than an actual stock, and such strong diversification may be the reason why the current stock price is nearly twice as high as it was during the 2020 March lows, and why it recently became the most valuable company in Europe, overtaking Nestle. So despite the recent appreciation LVMH has experienced, it is still worthy of a closer look. Overall, LVMH's revenue sank by roughly $6 billion in 2020, and while the company did warm up to selling their products online, I don't think we'll see an immediate shift in their business model. Due to customers wanting to go to the actual store, see and touch the products, potentially even be advised by the employees working there, and just overall turn the purchase into an experience. Something that the company themselves refers to as selective retailing, which could once again be possible in 2021, improving LVMH's revenue. Add to this that many of the sectors LVMH operates in would also profit from the economy reopening. It might become clear why analysts are projecting an increase of 18% in revenue and 67% uptick in earnings for the company. Similar to Starbucks, this company also pays out a dividend of about 1.14% that grew an average of 11% per year over the last 5 years. The third company in today's video is probably on everyone's radar, and that is Disney. Currently trading at just below $190, up roughly 66% on the 1-year chart and 44% on the 6-month chart. It is incredible to see how much Disney changed over the past few years. Unsurprisingly, the catalyst for this immense stock price growth is of course Disney+, that is close to reaching 95 million subscribers. Disney also owns 2 other streaming services, namely Hulu and ESPN Plus, that together boast another roughly 51 million subscribers, meaning Disney currently has a whopping 146 million subscriptions to their streaming services. With the company forecasting further growth in their subscription services, with Disney Plus alone meant to reach between 230 million to 260 million by 2024. To put this into perspective, that would be about 26 to 54 million more subscribers than Netflix has right now. So the reason why I included Disney on this list for stocks that could profit when the economy opens up is due to the fact that, similarly to Starbucks, the pandemic helped Disney reorganize their business. As such, Disney bolstered their e-commerce and suspended their dividend, with some speculating this may even be an indefinite move by Disney, who would be better off investing more into their streaming services or other investments than paying out a dividend. Whether that is true or not, the future will tell. Overall, I believe Disney is set up very well. So once theme parks do open up again and go from liability to revenue stream, this will just strengthen Disney's position even more. And with news of California already letting the theme parks reopen from April onwards, this is definitely a stock to keep an eye out for. Coming to the last stock of today's video, we have Airbnb. Airbnb operates in a sector that will probably stand to gain one of, if not the most, from the post-pandemic world, and thus many are speculating discretionary travel stocks will take off in 2021, with Airbnb's stock price being up over 22% on the year-to-date chart. However, taking a look at the 1-month chart, we can see a fairly sizable dip, with Airbnb being down nearly 8%, which some could view as an optimal buying opportunity. And while Airbnb is definitely not selling at a massive discount, with their price to sales ratio being at 31.8, a metric used to show how much the market values every dollar of the company's sales. This ratio can be effective in valuing growth stocks that have yet to turn a profit or have suffered a temporary setback, both of which apply to Airbnb, with a lower ratio being better. For reference, let's take a look at 2 rival companies of Airbnb, namely Booking.com and Expedia, that have PS ratios of 13.95 and 4.52 respectively, showing just how much the market is actually expecting from Airbnb, as they believe the stock has tremendous long-term potential, with the company estimating its total addressable market at $3.4 trillion US, with the company's estimated breakdown as follows: $1.8 trillion for short-term stays, $210 billion for long-term stays, and $1.4 trillion for experiences. How much of this market share they will ultimately obtain is yet to be seen, but nonetheless, Bank of America, among others, expect Airbnb will really start to shine in a post-pandemic world. That concludes the video. As always, I am not a financial advisor. Please do your own research before investing into any of the companies mentioned in this video. But for anyone curious, I have made a Trading 212 pie with the following stocks, which you can find in the video description down below. If you made it this far in the video, you might as well subscribe and like the video, as it really helps out my channel. And with that being said, thank you for watching, good luck, and goodbye.